Hi everyone. Today we will be presenting our financial analysis on the Tesla stock. Our group consists of 6 people.
Hi, my name is Waleed Ahmed.
Hi, my name is Farina Rafash.
My name is Ursulina Ali.
My name is Shamsul Arifin.
My name is Aisatul Berry.
And my name is Fabio Beatty.
All right. So the stock that was selected by our group is Tesla. Tesla is an incredibly large stock that grows at remarkable rates. This can be seen in its market cap that's set at 1.06 trillion. As you can see in the figures in the next slide, Tesla has done nothing but grow over the past 5 years, where the earnings have increased for every share. And you can see this as the line keeps increasing. Yeah, every stock has its up and downs, but Tesla overall has been growing. The reason being is that Tesla's high PE ratio, and we all know that the higher the PE ratio, the more valuable the stock becomes. Currently, Tesla has a PE ratio of 208.61. And this number is relatively high compared to the other stocks within NASDAQ. Tesla's price to sales ratio is 21.08. And this also is a very good sign, as it's relatively lower than its previously quarterly reports. Tesla, we can all say that Tesla is categorized as a very hot stock because it just keeps growing, not only in the past 6 months, but even before that. Tesla said that it would start its production of the Cybertruck this year and is also planning on starting production for its electric semi-tractor truck this coming year. Tesla's team is continually innovating and improving their technologies as they continue to disrupt the market. As per the current quarterly financials of the stock, the high and low earning estimates for the coming year are greater than the current numbers, as you can see in the chart in the next slide. And there you can see the quarterly values for the stock. Therefore, it's in our best interest to buy the stock as there is so much room for growth. Moving forward into the macro factors. Currently, Tesla shares are plummeting due to a lot of factors, and the financial market for Tesla is expected to see a gain because of the geopolitical tensions that are rising. As the Russia-Ukraine conflict continues, the increase in oil supplies is making the electric vehicle market an attractive market for everyone. Tesla's rivals are also well aware of this, and they continue to compete with Tesla in the EV race. Some companies are Ford Motor Company, which plans on launching its EV truck F-150 Lightning this coming spring. Another one is General Motors, and that's expected to launch in 2023. General Motors is also partnering with Honda for a newer project to develop an updated electric vehicle. Another one is Rivian Automotive, and they are creating an electric pickup truck, and that was launched at the end of 2021. So these are just some of the top rivals in the market that are going to continue competing with Tesla. As we see a lot of these new technologies and a lot of new competitors join, it's important that we take the rules and regulations into consideration. Limitations on energy consumption and the increased use of battery-powered EV is allowing Tesla to promote their products a lot, but these regulations will be there to keep the company in check. A lot of these standards are based on an international level, but different countries are implementing the same strategy in different ways. So for example, the safety standard consists of a wide variety of details, but each country is implementing it in a different way, still following the international standard ISO 6469 rule. Vehicle and charging infrastructure, safety and security connectors, charging topology, and EV communications are the main areas that are covered by today's standards. These international regulations are a way for Tesla to better their technology, as well as bring safety and reliability for their consumers. But moving forward, further implementation of these newer laws could serve as a hindrance to Tesla's expansion because it could, because of Tesla's very general and unspecific regulations.
Just as it's important to look at macro factors, it's also extremely important to analyze industries using pestle analysis. It's extremely important for any industry, but especially important for Tesla because it is a rather new company and electronic vehicle ownership has skyrocketed. Using pestle analysis, we'll look at the opportunities and threats for and to Tesla through 6 different standpoints: political, environmental, economical, social, technological, and environmental. From a political standpoint, Tesla does have an opportunity and a threat. Government incentives, which make electronic vehicle consumers eligible for a tax credit of up to $7,500, has incentivized the need to own an electronic vehicle. This helps Tesla. It's also an attempt from the government to push consumers into greener travel. This is an especially good push for Tesla because as it's one of the leading names in this front. A threat, however, is that due to political instability in the Democratic Republic of Congo, where almost 60% of the world's cobalt production takes place, Tesla does and could face a supply chain industry issue because the cobalt mining there can cease or stop completely because of multiple conflicts in the area and an influx of corruption. From an environmental standpoint, they do have an opportunity as climate change is an extremely pressing issue. Due to this, many consumers have consciously made the decision to switch to more environmentally friendly practices and to renewable energy sources. It's been a large attribute to the increasing number of electric car owners. From a social standpoint, the company faces both opportunities and threats as well. Elon Musk himself is one of Tesla's greatest assets. The CEO has become somewhat of an internet icon, and he does have a huge social media presence. It's why Tesla famously has little to no advertising expenditures in comparison to other companies. Musk and his company have amassed a cult following that almost cemented the company's name in the industry. However, this could also be a threat to the company because his name is so heavily attached to the company that any wrongly worded statement or action can affect his company's value. Another opportunity for them from this standpoint is that Tesla has revolutionized the electric car industry. Their early entry into the market allowed them to shape the way consumers view electric automobiles, and they were the first company to turn e-cars into a luxurious experience that contends with many top gas-powered cars. Before, the idea of an electric car was somewhat of a gimmick or didn't stand up to the gas-powered competitors, but Tesla has really revolutionized it and has made it a really high contender to these companies. From a legal standpoint, they have opportunities and threats. For example, an opportunity is that regulations on energy consumption have given Tesla the ability to market their electric cars and energy efficient products. Competing organizations need to adhere to these regulations that are meant to crack down on traditional gas-powered automobiles. A threat, however, is that laws and regulations in other countries could put a hindrance on Tesla's expansion into foreign markets. Elon Musk has expressed a desire to expand into foreign markets, but because of foreign policies and laws, he would have to alter some of Tesla's ideas and the way that they do things. From an economical standpoint, they face opportunities and threats. As Tesla continues to perfect its craft, we've seen their battery prices drop drastically. Previously, their batteries were a hindrance to the company because they cost a lot of money. The company benefits greatly from this price drop because it makes their automobile products more affordable overall. Another opportunity is that not only are battery costs dropping, but the same drop is evident in renewable energy costs. As gas prices continue to skyrocket to a historic high, the incentive to switch over to electric vehicles has just become stronger. A threat is that while current economic instability continues to be a problem for all industries, the automotive industry is especially struggling due to its susceptibility to economic downturns. A lot of automakers drastically cut productions due to low demand during COVID, but after sales started to uptick, they found themselves struggling to keep up with this rise in demand. This led to major production cuts and a piling of back orders and Tesla was not excluded from this. From a technological viewpoint, they have both opportunities and threats. Technological advancements can be both an opportunity and a threat for Tesla, because while technology constantly shifts and is updated, Tesla's products can become outdated, needing constant improvement, or else it will fall short in comparison to other companies. On the other hand, however, the new and more efficient approach to technology requires the company to provide the utmost quality in their products, which only increases the company value. Using pestle analysis, we can see that they do face threats. However, from my standpoint, I can only say that the opportunities far outweigh the threats.
Now that we have gone over industry level factors, let's dive into firm level factors through analyzing the risk and return analysis, capital budgeting analysis, financing analysis, and valuation analysis. First, let's assess risk and returns of Tesla. Tesla has a beta of 2.08, and beta is the measure of sensitivity of a stock's price compared to the overall market as a whole. Usually the S&P 500 is used as a benchmark, where a beta of 1 means a strong correlation to the S&P 500. Although Tesla is correlated to the S&P 500 due to Tesla's beta value being over 1, it is highly volatile. Such a high beta value means that Tesla has a very high risk of operating in the industry. Now, in terms of returns, Tesla has performed exceptionally well in the stock market in the past few years. Even though Tesla has never paid out dividends, they have become one of the most attractive stocks that produce huge returns. Their stock market return is only composed of the capital gain in their stock, and in the last 6 months, Tesla's stock market return was negative 1.86%, but in the last year, Tesla's stock market return was 37.78%. And in the last 3 years, Tesla's stock market return was 1,804.13%. The level of growth in share price is very attractive to investors. But it is key to note that it comes with a risk because of how volatile the stock is. For instance, gains and losses can be significantly large. And now, Tesla's returns on assets, it's 7.14%, and return on equity is approximately 20.43%, which is also very attractive to investors. As we look at the capital budgeting analysis regarding Tesla's investment decisions, they have allocated large amounts of resources to the future growth of the company. Tesla's property, plant, and equipment PPE ratio to the total asset adjusted for accumulated depreciation is around 50.18%, while Honda's PPE ratio to total assets is approximately 36.23%. Tesla has far more invested in their long-term projects for future growth. Tesla's PPE has increased in size by 33.37% since the previous year, while Honda's PPE increased only by 3.43%. That's almost 10 times larger. Additionally, 2.76% of Tesla's total assets are intangible assets, including goodwill. On the other hand, Honda's intangible assets, including goodwill, is around 3.74% of their total assets. Tesla's intangible assets has actually increased by 230.19% since the previous year, while Honda's has merely increased by 7.67%. And finally, research and development. Research and development is a major factor in a company's future success. When it comes to research and development expenses relative to total assets, Tesla's R&D expenses is 4.17%, while Honda's is 3.37%. Since the previous year, Tesla has increased its R&D expenditures by 73.91%, while Honda has dropped 8.11% of its R&D spending. This is a huge sign of Tesla investing for future growth, advancing their technology in their automobiles, and having a competitive edge over their competition. And it's one of the reasons why we should invest in Tesla.
Now I will go over with Tesla's current ratio, debt to equity ratio, and interest expense ratio. Tesla's current ratio. The chart here shows Tesla's quarterly current ratio calculated for period from 2015 to 2021. The trend of the plot shows that the current ratio has decreased since 2015 and reached a new low in early 2018 and at 0.73. The current ratio has somewhat remained flat throughout 2018 at an average ratio of 0.80. Now, if we compare this with General Motors, current ratio of Tesla fluctuated a lot over the past years, while General Motors remains comparatively stable. However, in the line with the success of Model 3, their current ratio has been healthy since late 2019. Next. Tesla has been cash flow positive for the last 4 quarters, and they have been aggressively paying down their debt. As a result, their debt to equity ratio has declined from 2.97 to only 0.17. On the other hand, General Motors has been highly leveraged with debt equity ratio with 3.50 to 4. Next. Interest expense. On a quarterly basis, Tesla's interest expense has been on a rise since fiscal 2015, but may have topped out in fiscal 2020 before starting to decline. Tesla's interest expense started to moderate and dropped below at 100 million level in the first 2 quarters. When Tesla's total debt rose, interest expense followed suit and vice versa. If we compare this with General Motors, then currently Tesla's times interest earned is 113.12. In 2015, it was minus 0.09, which is higher than General Motors, but in past Tesla had negative margin. And General Motors times increase interest decreasing day by day.
Valuation analysis. Basic information on both companies. Tesla 2021 total asset income. Tesla 2020 total asset income was 52.1 billion, while in 2021 it increased to 62.1 billion. On the other hand, General Motors was 65.8 billion. Market capitalization for Tesla 2020 was 668.9 billion, while in 2021 it increased to 1.0 trillion. General Motors for 2021 had a total market capitalization of 85.1 billion. Market value for 2020 Tesla was 645 billion, while Tesla 2021 was 1.0 trillion. General Motors for 2021 was 19.3 billion. Market book ratio for 2020 Tesla was 28.9, and in 2021 it increased to 34.2%. To 34.2. General Motors was only 1.2. Next. Net income of Tesla for 2020 was 690 million, while in 2021 it increased to 5.5 billion. General Motors was 9.3 billion. Capital employed for Tesla 2020 was 37.9 billion, In 2021, it increased to 42.4 billion. General Motors 2021 capital was 170.3 billion. Residual income for Tesla 2020 was negative 752.1 million. In 2021, it increased to 3.5 billion, while General Motors was 3.2 billion. Return on equity for Tesla 2020 was 29.9%, while in 2021 it decreased 20.4%. General Motors for 2021 was 15.2%. Return on asset for Tesla 2020 was 6.2%, while in 2021 it increased to 7.4%, while General Motors was only 0.0%. Return on capital for Tesla 2020 was 4.6%, while in 2021 it increased to 16.7%. On the other hand, General Motors was only 0.0%.
So now we're going to talk about how to measure the efficiency of these two stocks, which are Tesla and General Motors. So we have different ways to do it, and we're going to look at asset turnover ratio, inventory turnover ratio, average days in inventory, receivables turnover, coverage collection period, and the DuPont system. So for the first one, which is asset turnover ratio, Tesla was looking at a 0.73. In 2021, it was 0.94, and General Motors was 0.52. In inventory turnover ratio, Tesla for 2020 had a 5.9%, which increased by 1%, which is 6.9% in 2021, and General Motors at 8.4% for 2021. Now, the average days of inventory for Tesla in 2020 was 63.3, and it decreased by at least 10 in 2021, which is 53.3, and we're looking at General Motors for 2021 at 3.2. Next, we have receivables turnover, which was 23.7 for Tesla in 2020, and then 28.5 in 2021, compared to General Motors for 2021, which was 3.7. Next, average collection period, which was 15.3 in 2020 for Tesla, decreased to 12.7 in 2021, and we're looking at a 97.8 for General Motors in 2021. Now we have the DuPont system, which for Tesla was 2.8%. For Tesla in 2021, we see a 9.5%, and for General Motors in 2021, we see a 4.5%. So now we're going to look at other ways to measure a stock. We're going to measure a leverage. So to measure the leverage, we're going to look at the long-term debt ratio, which was 26.9 in 2020 for Tesla. Then you have 12.06% in 2021, and General Motors only has a 1.87%. Now, that equity ratio for Tesla in 2020 was 36.89%. In 2021, it was 13.72%, and General Motors has 114.9% in 2021. So now the leverage for these two stocks in 2020, Tesla has a 55.75%. In 2021, Tesla has 50.08%, and General Motors in 2021 is looking at a 73.11%. Now the time interest earned for Tesla in 2020 was 2.5. It has significant rise in 2021 at 18.1%, and General Motors has a 14.39% in 2021. So now the cash coverage units ratio for Tesla in 2020 was 2.5%. In 2021, it was 18.1%, and General Motors for 2021 was 14.39%. So the ROE, or return on capital, for Tesla in 2020 was 3%. Then we can see a significant rise in 2021 at 17%, and General Motors in 2021 has 15%. So now the net working capital for Tesla in 2020 was 12.4 billion. It decreased in 2021 to 7.3 billion, and we have General Motors in 2021 at 7.6 billion. So now the net working capital to total asset ratio for Tesla in 2020 was 24%. It decreased by half in 2021 to 12%, and we're looking at General Motors at 3.1%. So now we have liquidity ratios and sustainable growth. So the quick ratio and the cash ratio are two ways that you can look at a liquidity rate, at a liquidity of a stock. So for Tesla in 2020 was 1.5. For 2021, always for Tesla, was 1.02, and General Motors we have 3.7. The cash ratio for Tesla in 2020 was 1.4. In 2021 was 0.9, and for General Motors in 2021 we have 2.9. Now we're looking at sustainable growth, which for both Tesla and General Motors, the payout ratio is 0, because Tesla has never given dividends, and General Motors, as of 2020, due to pandemic, they stopped giving dividends. The plowback ratio is 1 for both Tesla and General Motors in 2021 and Tesla in 2020. And the growth in equity from plowback is 0 for Tesla in both years 2020 and 2021, and General Motors in 2021. So as you can see from our presentation, we as a group really believe that Tesla is a safe and profitable stock. So thank you so much for listening. Hope you have a great one.